Good evening and welcome to tonight's market wrap. Let's start with the numbers. The Nasdaq closed at 26,225 points, down 1.54%. The S&P 500 finished at 7,408, a decline of 1.24%. The Dow Jones Industrial Average ended at 49,526, down 1.07%. The VIX Volatility Index rose to 18.43, while the 10-year Treasury yield held at 4.59%. The dollar index climbed to 99.27, and offshore yuan traded at 6.81 against the dollar. Gold settled at $4,555 an ounce. Crude oil remained above $105 a barrel. Bitcoin also fell 1.17%. Today's market showed a very clear pattern. Money flowed out of virtually all risk assets and even some traditional safe havens, moving directly into cash and short-term treasuries. This was a pure de-risking process. The weakness started in Asia. Despite China's central bank cutting reserve requirements, the A-share market still closed lower, with the Shanghai Composite down 1.02%. This shows that macro-easing policies cannot offset the global tightening expectations. European markets then amplified the panic. The Stoxx 600 recorded its biggest single-day drop in 2 months, directly triggered by the global bond sell-off and the spike in Treasury yields. U.S. stocks opened under pressure and traded lower throughout the session. Tech stocks were hit hardest, with Nvidia falling more than 4%. The core driver was the 30-year Treasury yield breaking above the key psychological level of 5.1%. This completely crushed confidence in high-valuation growth stocks. There was no meaningful rebound during the session, and no bargain hunting at the close. That tells you how pessimistic the market has become. Now here is the most important surprise of the day. The U.S. Producer Price Index came in lower than expected, which is clearly a sign of cooling inflation and should have been positive news. But the market completely ignored it. This is a classic case of ignoring good news, which signals underlying weakness. The market's pricing logic is now entirely dominated by interest rates and the Fed's hawkish expectations. A single inflation data point cooling is no longer enough to reverse the bearish sentiment. We also made a major mistake on gold. Normally when the VIX rises and stocks fall, gold should act as a safe haven. But today it dropped sharply. The core reason is that the market's number one pricing factor right now is Treasury yields and the dollar. When a strong dollar and high interest rates appear together, gold as a non-yielding asset loses its appeal. Its financial attributes are completely suppressed, leading to a decline alongside stocks. Looking ahead, until Treasury yields and the dollar index peak and reverse, any attempt to buy Asian stocks will be swimming against the tide. The strategy should be defensive. Avoid sectors sensitive to interest rates and currency movements. Asian markets will likely open lower tomorrow, with semiconductor and tech-related stocks facing the heaviest selling pressure. We recommend staying on the sidelines and waiting for clear turning points to emerge. That is all for tonight. Thank you for watching.